Hello, my name is Steve Kasanovich. You are attending the webinar between the CBOE Futures Exchange and OptionsCity. Today's topic is going to be trading VIX Futures. We're live here in Chicago, and we'd like to welcome everybody. We're going to have 4 participants, including myself. The first is Jennifer Fortino from the CBOE, Jay Caauwe from the CBOE, and Jim Ivet from OptionsCity. And my name is Steve Kasanovich. I'd like to welcome everybody. And at this point, we're going to turn it over to Jennifer to let her start talking about the VIX Futures.
Hi, thank you. Thank you, Jim. Thank you, Steve. Thank you, OptionsCity, for having us here. Today we are about to begin a 3-part series of webinars on trading with VIX Futures on the CBOE Futures Exchange. So today we'll go over a few basic topics, trading VIX Futures. As soon as we can get the slide working. Okay, so before we have to show this disclaimer, we'll pass right through that and go right to the agenda. So, as you can see, the main points of the webinar that we will go over will be building blocks of VIX futures and options, why to trade VIX futures, VIX index fundamentals, as well as VIX futures fundamentals. So let's have Jay talk a little bit about the building blocks.
Good morning, and thanks, Jennifer, and thanks, Steve and Jim. Pleasure to be here. So the building blocks of VIX futures, and again, as Jennifer mentioned, this is the first of 3 lecture seminars, call them what you want, about trading volatility, in particular VIX futures for this first lesson, and VIX options a little later on. And we conceptualized introducing the topic of VIX futures through this whole building block type of scenario. Yeah, it kind of harkens back to the building blocks of your grade school days, but you know what? Volatility is such a esoteric type of concept that we felt that for introductory and explanatory purposes, it's nice to kind of give you the lay of the land, because what we are operating with are derivatives of derivatives. So it all begins with volatility. That's what VIX is. It's an expression of volatility. So what is volatility? It's essentially a measure for variation of price within a particular financial instrument. And for our purposes, that financial instrument is the S&P 500 index. So when we look at that S&P 500 index, more specifically, the VIX is going to be derived from the index options themselves, traded at CBOE, so the SPX. Once we know what we're deriving our methodology for this index, the VIX index, then we can grab the components that make up the index itself. The VIX index is comprised of the out-of-the-money calls and puts within the S&P 500 index options. CBOE calculates a value for VIX index based on the midpoint of the S&P 500 index options. Again, they're out-of-the-money calls and puts. We use the midpoint, plug them into the VIX calculation, VIX algorithm itself, and every 15 seconds, the exchange disseminates a VIX index value, that well-known and highly regarded fear gauge, for lack of a better description, on volatility in the marketplace. And it is from the VIX index that we derived the futures. Beginning in March of 2004, CFE was created out of CBOE. CFE is the CBOE Futures Exchange. We went live with VIX futures back in March of 2004. About a year and a half, maybe 2 years later, VIX options were created. VIX options are, while you will read and hear that they're based off of the index itself, the fact of the matter is that they price themselves off of the VIX futures. So we had settlement today for both the futures and the options. Important to note that they both settle to the same value. So again, what is volatility? Essentially a measure of fluctuation of a market price. But again, remember that it doesn't measure direction of the price changes. It merely measures their dispersion. Certainly, folks view it as a measure of risk or uncertainty. And when you look at the actual number itself, so when you're looking at your Bloomberg or CNBC and you see that 33.70. What that does is put it in a annualized term. Sorry, that's the word I was looking for. Annualized term of what volatility is going to be. So at this point, let's talk about the type of volatility VIX is itself. It's based off of implied volatility. So implieds are derived from current market prices, where historical or realized volatility is taken from time series of past markets. So it's important to note, because a lot of players out there, investors, traders alike, essentially are looking to kind of capture movements between what is anticipated or expected versus what will actually take place or has already occurred. So they're playing implied against levels of historical volatility.
Thanks, Jay. Let's go over a little bit of the S&P 500 index options. We'll start with the fundamentals, because to understand how to trade VIX futures, you will need to understand the S&P 500 index options, because as Jay said, VIX futures pricing is actually based off the S&P options. The expected or implied level of volatility is factored into the options premium. CBOE S&P 500 index options are based of calls and puts, and the options pricing are made up of intrinsic value, time value, as well as the Greeks. Implied volatility components, otherwise known as vega, consist of higher volatility, higher expected fluctuation, where lower volatility, you get lower expected fluctuations. To understand a little bit more about the VIX index, you need to understand that the VIX index itself is not a tradable index. So what is the VIX index, you ask? If it's not a tradable product, it's a measure of where the market will be 30 days based on the S&P 500. As shown on the slide, VIX is derived from the S&P index options, and as Jay mentioned, and is a measurement, again, where volatility will be in the next 30 days. So tomorrow will be another 30 days from today, or tomorrow, where the VIX index will be. It's constantly calculating 30 days out from any given day. And I know Jay can give us a little bit more detail.
Right, and you're going to see some redundancies in a few of these slides, but because this is an introductory seminar going on, we felt that it's important to kind of hammer home some of these nuances of volatility trading. So as Jennifer mentioned, we derive VIX from the SPX options, and it's based off 30-day implied or expected volatility, right? So today looks 30 days out, tomorrow looks another 30 days out. But if we go into the futures, what the futures are doing are looking at forward levels of VIX, not spot itself. So let me explain it a little bit more. Today we had September settlement. So October is now the front month. When you look at the October price for VIX futures, it's expectations for where VIX will be come October futures settlement. So again, while VIX itself is looking at a forward level of implied volatility 30 days out, the futures are looking at also a forward level of volatility, but pricing themselves off of what is anticipated or expected for VIX to be on that VIX futures settlement morning. That's it in a nutshell, but it's important to kind of rehash that, refamiliarize yourself with it, especially for new traders out there. And while there's a lot of OptionsCity folks here are familiar with the options trading, futures do have a little bit more of a nuance to the trading, especially as it applies to vol trading here. So VIX options, as I mentioned, were listed in February of 2006. Happy to say that at times they're our second, undoubtedly third most active index product for the exchange, behind things like the Spiders and SPX. And again, they're based on forward levels of VIX. You'll hear folks say, well, they're based on cash, only because they are SEC-mandated products, so we say they're based on the underlying. But again, VIX options follow VIX futures. So when we're looking at options and futures, what are they actually looking at? And because you have this 30-day implied volatility aspect to it, October VIX futures are looking at November SPX options. Again, the futures look 30 days into the future to the next month's SPX options contract to derive their pricing. So if you look at where November SPX settles, and you count back 30 days, you'll end up on where VIX futures will settle. And we just had that settlement again today. So to kind of rehash and recap, we end this chapter with the whole building block framework of the presentation, and that is we started with volatility and what volatility is. And again, it's a measure not a measure of the price changes, merely the dispersion of those changes. And it's derived from the S&P 500 index, but more specifically, the index options that are traded at CBOE. And from that, we get the index itself of VIX futures and then options. So you see we have a lot of more or less derivative of derivatives out there.
Right. Thanks, Jay. So let's go over a little bit more of the VIX Index and what it is. As you can see on the screen, it's a measure, again, of 30-day implied volatility in the S&P 500. We should start counting how many times we tell everybody this, huh?
Just want to hammer that home. Exactly.
So some of the characteristics to remember about VIX is that it has an inverse correlation to indexes in the equity markets. So what that means is while VIX tends to increase greatly in falling markets, it decreases in smaller amounts as equity markets rise. Prices will eventually return back to the historical average. Other asset classes that we can compare VIX and VIX futures to, Google or crude oil. I'd say those are probably most volatile.
Quite volatile, but yet certainly VIX is a lot more volatile than some of those asset classes. And as you mentioned, Jen, I mean, it's important to note that it's not only equity classes, but other commodity type classes too, like gold.
Right, exactly. Okay, so why trade the VIX? Jay, why should we trade VIX?
Well, it's an important portfolio diversifier, if nothing else. People look at it certainly as a gauge of market sentiment. But let's say you have a directional view on volatility. If you expect volatility to back off from this current mid-30s type of area, you may look to establish a position towards the short side. Again, as Jennifer mentioned, the mean reversion aspect is something to consider. And I think, if memory serves me, and if I remember from my research notes, that mean is right around 27, 28. So if you think back to 2005, 2006, when vol was right around single digits, it was at 10 per share, and I think it dipped below there. Expectations were that it wasn't going to stay there forever. It certainly can't go to zero. So people were preparing themselves and anticipating some type of black swan event, some type of event that allowed them to establish long positions, looking not only for the mean reversion to kick in, but also for that spike in volatility. As Jen mentioned, we have this negative correlation with equity indexes. That's a very popular chart I think most traders have seen as the market gets pummeled, like we saw a lot in August. You'll see where the VIX index has spiked broadly to the upside. And the futures tend to follow lockstep with that index. At this point, kind of as a sidebar, the VIX itself is not tradable. It is not a cash product, much like the S&P 500. Yeah, sure, you can replicate via a basket of SPX options, but because the SPX is constantly moving, what's in the money is not in the money 15 seconds from now, 15 minutes from now. So it's essentially very hard to replicate the index itself. Futures offer the closest correlation, or should I say relation, to moves in the index itself. So when you see spikes in vol, when you see that pop in VIX itself, expect to see the front month VIX futures carry a similar sentiment. They may not move penny for penny with it, but you're going to get more sensitivity in those front-month VIX futures than you will further out on the term structure. And we'll talk a little bit more about term structure later on. And certainly, trading a futures contract gives you a tremendous amount of leverage in that the contract, and when Jen goes into the contract section, she'll talk about the $1,000 multiplier size. So one only needs to do the math to realize that by posting futures margin, you're getting a lot of bang for your buck. Again, that's what futures leverage essentially means, that you're posting margin and getting access to a product that has multiples of what the margin you posted. It is an exchange-listed product, centrally cleared at the OCC. There are robust, deep, dynamic markets, both sides of the, or on both the bid and offer. And again, as I first started the slide with, it's a tremendous diversifier. Folks are using it to kind of smooth out bumps in the road as their equity portfolios had suffered during the crisis of 08, 09. View it as an insurance product too, much as you have insurance on your home and your car. You don't count on the house burning down or getting into that accident, but having that insurance in place certainly takes care of those events, and that's what VIX can do when the market is under times of stress.
Thanks, Jay. And again, because we feel redundancy is the best way to learn about this product, to just recap real quickly here what we said earlier about the characteristics of volatility. VIX is negatively correlated to the equity markets, while VIX is positively correlated to credit prices. And again, that mean reversion, most likely the prices will eventually return back to the historical average. So with that being said, we will move on and learn about VIX futures. What they are: futures contracts on forward or future levels of VIX. And as Jay stated, I will go over the contract specs with you now. As you can see, VIX, well, we have here they open at 7 a.m. Currently, it actually opens at 7:20, but we are looking to change that as early as next week. It's open early. We do see significant volume in the early mornings. As of recent, it's been about 5% of the whole day's volume is done before the actual 8:30 open, like most other products. So with that being said, the VIX product, as Jay also mentioned, is 1,000 times the VIX futures price. Now, we do have a mini VIX contract, which is 100 times the futures price, but here we're talking about the large VIX futures product. The minimum tick size is $50 per tick, and the product is traded in nickels. Currently, we have 9 contract months trading at one time, and as Jay stated earlier, today was expiration, so the September contract went off. Actually, yesterday was the last day that it could trade, and then the settlement price gets calculated in the early morning AM prior to the 8:30 open. So come next Monday, we will then list the next far-out month, which is
June, I believe. June,
yes. And then we had May, and then we'll have June. Yes, thank you, Jay. So the last trading day, as I said, is yesterday, the day before it actually settled. And the way the final settlement prices of VIX futures are calculated, they are calculated from the opening traded prices, and I do emphasize traded prices in the SPX index options.
Yeah, that's important to know. Sorry.
No, go ahead. Go ahead.
Because you expect the conversions of the index level and futures to occur. And again, the index is based off midpoint of the SPX options used in the calculation. But the SOQ is based off of traded prices. So I suppose mathematically, you will never have 100% true convergence. So there will always be this little bit of space between where the actual index itself is on settlement morning versus where the expiring futures contract month went out.
Thank you, Jay. That's good to talk about. It is a cash-settled product, and the margins are stated there for now, but they do periodically change. So if you'd like to maybe talk a little bit, Jay, about the
Yeah, sure.
relationships between VIX Futures and VIX Index.
Yeah. So all one has to do is look back to events of August and kind of monitor what happened when events started to present themselves in the market and what occurred in the VIX Index itself, and then look at it versus the futures. And again, I mentioned earlier that shorter-term futures are more sensitive to moves in the VIX Index itself. Definitely true. Definitely true. Again, look back at August. Look back at, I suppose the flash crash would be a good example, and certainly events of 2008 and 2009. The front-run VIX futures will move more in lockstep with the index itself. Why is that important to note? Because people are constantly looking at the term structure. They're looking at the curve. Now, historically, the VIX futures observe an upward sloping structure, so you would expect the further out months to be priced higher. It's certainly hard to ascertain or measure where volatility is going to be 5, 6, 7 months out on the time horizon. So there's a bit of premium kind of built into those expectations for future levels of volatility. So that's one way to measure where you want to get into the market and what futures contract month you want to look into. And I'll go more into spreading in a little bit, but it's important to maintain a pulse on what's going on in that term structure, because as the slide shows, it can be upward, it can be downward, it can be flat. In fact, I think it was in 2008 that there were periods where the term structure flat to inverse, where if you were rolling your front-run futures into the next term, you're actually getting paid. Now, it's understood that during a contango or an upward sloping term structure, that roll costs are part of that transaction. So in other words, if you buy and hold VIX futures, it's almost understood that it's going to have a negative return because of those roll costs. But because that can change, and we saw it definitely in 2008, that term structure went flat to inverse. This past August, we saw that term structure almost observe a smile, where the front-run futures contract and the very far out VIX futures contracts were priced higher than the midterm. So again, that kind of addresses that whole smile aspect of the term structure. So further to the point about the futures and its relationship to the index, remember, futures, again, one of these redundant slides, but again, as Jim mentioned, important to reiterate and remind yourself of that they are based on forward or future levels of VIX, not the VIX, not the spot VIX itself. So if there was one takeaway from this particular slide, it would be that little box down in the lower right-hand corner, that the futures are based on market's expectation for the level of VIX at expiration, and to that I would add expiration of the futures contract.
We like red, so we make sure you see everything we want you to see. So in this slide, you can see we circled it in red. The VIX futures trade independently of the VIX index prior to expiration. Again, we know we said it before, but we just want to make sure that it hits home with you guys. So I think that what I want to show you is my favorite. Hold on here. Where'd my slide go?
Such a favorite that
I lost it.
That's the next one I show. VIX
Okay, VIX. Oh yeah. Okay. You know what? I'm just a little okay. Anyway, so here.
I'm talking about VIX defined for a trader? Okay. All right. So again, some friendly reminders out there. It's based off of 30-day implied volatility. So today it's looking 30 days out. Tomorrow it's going to look another 30 days out. It comes from S&P calls and puts, the out-of-the-money calls and puts. It's expectations for the future level of spot VIX itself, or AKA forward implied volatility. There is no decay on it. It's pure implied volatility into itself. Spot and front-run VIX futures do have this convergence that occurs at expiration, but as I mentioned, one can not count on it meeting at the same price level. Again, a lot of that has to do with the fact that the index itself is based off the midpoint, whereas SOQ is based off traded prices. And because there is no tradable underlying, in other words, you cannot trade VIX itself, there is no cost of carry between the spot and the futures, much like you see in traditional commodity products or S&P futures.
All right, thank you. Okay, so I got a little tripped up there, but now I'm back in line. So just to recap what Jay said, this is just a quick slide showing you bullet points of what Jay just went over. No traditional futures, the cash relationship, no cost of carry, current VIX futures. Price is, where the market's estimated to be, what the VIX index will be at settlement. So, again, VIX futures prices based on expectations. And now I find my favorite slide. So I was just jumping ahead. And what I like about this slide is that it's just such a great analogy, so simple to understand, where VIX and VIX futures, what they mean. So basically the question is, what is today's temperature? And what does that tell me about the temperature on December 25th? And the answer depends on today's date. If today's August 23rd, the temperature tells me nothing about the temperature on December 25th. But if it's December 24th, we obviously know that the following day will probably be just as cold in Chicago as it is on December 24th.
Great analogy. I like that one.
So
we just got a question come in, and it's from Michael, and he wants to know, how's this read? Oh, okay. Why not put buying over VIX futures? That's a great question. We do get asked that quite often, and frankly, I don't know that there's one good answer to that, but I think a reasonable answer is that why not use a little of both? There was a smarter man than me that once said, each responds differently to moves in the marketplace. So your puts, your downside protected puts are certainly going to respond a little different to moves in the market, especially depending on how out of the money they are at a particular time. The same can be said for which VIX futures calendar or contract month you're trading at a particular time. So while you can view the protected puts as insurance, you can also view that VIX futures as your insurance, and again, consider that they move different and respond differently to moves in the marketplace.
thanks, Jay. And we'll talk about here VIX futures trading opportunities, and then we'll talk about some trading strategies. But to begin with, the trading opportunities, you want to trade the direction of the equity market implied volatility. You can trade calendar spreads. You can the term structure curve of implied volatility. You can use VIX index and futures as indicators. You can hedge your portfolio. You can trade implied volatility versus realized volatility, as well as you can manage your options positions. And Jay, maybe you can go into a little bit more of the VIX futures trading strategies.
Yeah, so I'll jump around a little bit on this slide. Jen just mentioned plain a whole implied versus realized. In the early days of the contract, there was a fair amount of firms, funds, folks out there who were establishing OTC variance positions, which are essentially a realized play, and they were using the VIX futures as their hedge, looking for the realized to come, or I'm sorry, the implied to come more in line with the realized over the length of the contract. So that's one way you can look at it, and certainly you can have a directional view and just say, hey, VIX is going to go up, I'm going to get long here. Volatility, as Jen mentioned earlier, VIX certainly has a higher level of movements in volatility when compared to other asset classes. Again, term structure too, very important to note. As I mentioned, it flattens, it stays the same, it develops a smile, it steepens. The nice thing about spread trading too within the futures complex is it's a whole heck of a lot cheaper to put on a spread trade too. So when you have time, look at those products spec charts, and you can see what the actual spread margins currently are. And I think you would agree that if you're looking to establish a position in VIX futures, aren't quite sure about where near-term applied vol is going to be, but you want to have some protection on that certainly spreads are a cost-affordable way to establish a VIX futures position on. Inter-product spreads or relative value play, yeah, we see a lot of that going on. Certainly times of market stress, folks who are trading E-minis will like to use VIX futures, again, because we know that the VIX itself is spiking a lot heavier and hotter. So folks are essentially doing a vol-on-vol play. We talked about the OTC variance players that were involved in early days and are still there. And credit spreads. Credit and VIX have this positive correlation, so they're both going to move in the same direction. So folks that manage credit portfolios find the VIX very handy and useful in that sense.
Thanks, Jay. And I think that just to give a little rundown, I looked back to see where the initial spread for margins were, and I think right now they're about $625 for initial, and maintenance is $500. So.
Perfect.
Yeah.
Perfect. And
even make note of that.
Yeah, and even cheaper for mini VIX too.
Right, right. Okay, so let's see. The next slide we'll go to.
But we've got a question here, and what is
it? Another question.
John asks us, what is the symbol for VIX settlement quote? Is there a difference, or that would just be, I think he may be referring to that SOQ, but it still would be quoted in just VIX, just final settlement, correct? For first take today, for instance?
Right, and you know what, John, there actually is a settlement value ticker symbol for the expiring, and I want to say it's .VXO, but I would need to check on that. So if, you know what, our emails will appear at the end of the presentation, so if you could shoot Jennifer or myself an email, we'll get that information to you. But yeah, you're right, there does exist a separate settlement ticker symbol. Additionally, provide us with contact information, anyone that's attending the event today, and we're happy to put you on distribution lists that provide not only settlement information, but everyday, end-of-day settlement information or closing values.
And new products, I would assume, as you will.
Oh, absolutely.
John also asked if there will be a recording made available of this webinar. Absolutely, John. It will be on the OptionsCity website pretty quickly, within a day or so afterwards, and we are going to also share that with the CBOE Futures Exchange, and they will have it somewhere.
Right, exactly. Yes. Okay, so.
Oh, my God, I'm sorry. All right, sorry. Go back.
I can't seem to.
That doesn't show up on there, so anyways, go ahead. Oh, did we?
I can't move that.
Oh, okay. Here we go.
Oh, no, now they're going.
Okay, there we go.
Does everybody see that? It's really quick. Okay, so to talk about VIX futures, we just wanted to show you the little circle of life chart attached and the way these products that we discussed throughout the webinar all come together. We want to make mention that VIX futures are extremely liquid, where volume and liquidity are mainly concentrated in those first few months. So usually the average bid-ask spread about 1 to 2 ticks in the front months, and maybe about 2 to 4 ticks in the back months. And on a delta-adjusted basis, VIX futures trade a similar amount as VIX options do. Just wanted to make note of that.
That's because the options are a $100 contract versus the futures $1,000 contract, and our independent internal research shows that not all option trades that are occurring are Delta 1. So when you kind of break it down and do it on that not only Delta but contract size adjusted basis, you'll see that the futures are trading a equivalent amount. So let's talk about that futures volume for a second.
Yeah, that's August, our best month.
Yeah, fantastic growth. And in fact, Jim, if you could go back to that previous slide just for a second. In the circle of life, we always had those 4 little arrow points there, but under the VIX options one, a few years ago, we wouldn't have had that mention of VXX and VXZ. So for those who aren't aware, VXX and VXZ are the Barclays created notes tied to VIX futures. VXX is the front 2 contract months, and VXZ looks at month 3, 4, 5, 3, 4, 5, 6. It looks at the midterm structure of the VIX futures. So if we go back to the volume chart, you will definitely notice, next slide please, a lot of upward growth near the latter half of 2010. These notes were introduced, I believe it was 2009, maybe during the first quarter of 2009. And certainly Barclays did a yeoman's job of promoting these notes and volatility trading itself. But also what happened, also let me add too, since that point and that last count, I think there's somewhere close to 25 different bank-issued notes tied back to VIX or VIX futures. Some are a little more highly structured, some are a little more private placement bespoke. But what it does is drive volume, drive interest back to our exchange, and frankly, at the end of the day, it makes the futures look fairly easy to use if you compare it against some of these certainly leveraged or inverse and highly structured notes. But with the advent of that notes and the growth that we saw attributable back to those notes, it also started to pull in some of the players that we were very keen on getting, prop shops, other market maker groups. So now we've reached a point where our volume, and our record volume in terms of ADV and open interest, is supported not only by the hedge funds who continue to do the OTC realized versus implied plays. Prop shops are now in their trading because they look for a product that offers them in and out opportunities, and they know that based on the numbers that we are posting, based on the markets that are out there being quoted, looking at the book depth, that they're able to day trade this product. Furthermore, we are working with the CTA community, commodity trading advisors. So while VIX futures traditionally did not need what they need in terms of trends, they look for small trends, and usually that's prevalent in commodity contracts. They had that kind of moment after events of 2008 where they realized that an allocation the VIX futures could have helped out some of those bumps in the road or where correlations fell apart in their commodity trend following strategies. So again, our recent volume, our recent growth points back not only to what's occurring in terms of hedges coming out of the VIX options, but a whole consortium of users across the investment spectrum.
Thanks, Jay. And to go a little bit more about the VIX and how popular it is, we have two other products related to the VIX, and I know we briefly touched on the mini VIX earlier today. The mini VIX is 100. The value is 100 as opposed to 1,000 as the large VIX. But for all you OptionsCity option traders out there, we actually have a weekly option on the mini VIX. So what it is it's a contract that comes on each week, and it expires the following Friday. So some of the specs we'll just go over a little bit is that it trades regular index trading hours, which is 8:30 to 3:15, so it does not trade earlier than that, as the large VIX does. The contract size is one mini VIX futures contract. There's always 4 consecutive contracts at any given time with the weekly expiration. The contracts begin trading on Thursday, and they expire the following Friday. They are American style, which means you're able to exercise early. And unlike the VIX futures contracts, which we noted were cash settled, these VOW contracts are actually physically delivered at settlement, meaning that the one mini futures contract for one option contract. So we just wanted to touch base on that a little bit. But to learn more about VIX and VIX futures, VOW, mini futures, you can visit us at our website right there. You can sign up to our monthly newsletter. You can always see the new information that we have coming out, new products, anything of the sort. So with that, I'd like to turn the microphone over to Jim from OptionsCity.
Thanks, Jennifer and Jay. That was a really great primer on the history of the VIX Index and the futures on the VIX. Bear with me while I get this up. You know, part of the reason when OptionsCity and the CBOE Futures Exchange, when we decided to do this joint webinar, obviously there's much more interest in the VIX, but you know, from a trader's perspective, as Jay alluded, you know, this index has been around for a while. The futures have only been around since '04. Is that correct? But I think, what I take away as a trader is you look at that chart and you see the exponential growth since the 08, 09 area. And especially, and he talked about how it's becoming more acceptable in the prop trading community and now with hedge funds and CTAs. Once you get over that critical, I would guess a lot of these look at maybe 100,000 contracts. It just looks like a round number. And then the interest in it, that kind of just feeds on itself. And so that's where people are like, hey, this is actually tradable now. The VIX, VIX that you would see on the television as maybe a gauge of an indication of where you think the market, is going to go. That's all fine and dandy as an indicator, but to actually trade it, and now the fact that they created this future and now that it's become so acceptable, that's where traders start looking. And to further that point, that's where they're trading opportunities. Thus, OptionsCity, that's where we come in. We pride ourselves in one of our main strengths is presentation of opportunities for traders. And so basically what I'd like to do is I'd like to kind of take you through who we are, what our software does, and how we can present these opportunities for you, especially in the option space. Just quickly, we're going to, I'll go over what I'm going to talk about, and I will try to make this brief. I know that, everybody's watching the market today, and we've got the Fed announcement in a little while. So I want to get you back to that if you're trading, or if you're interested in trading. I still don't want to take up too much of your time. I'm going to give you an overview of why you want to use OptionsCity. Our main strengths are our speed of our software, the powerful nature of our software. There's so many different things it can do. It's an intuitive process. We've really put a lot of thought into, why you want to make this work, what traders are looking for, and how to apply that to your trading strategies. The structure and connectivity, we're a server-based architecture platform, which I'll get into in a second. The connectivity, we have great relationships with basically every clearing firm in Chicago and in New York or wherever else you are, and with third-party providers. If you're new to the trading world and you need help with partnership, hey, I want to use OptionsCity, but I don't really know what to do, we're very good at helping you with that. If you're a current clearing firm or trader at a firm, we've probably got good relationships. We can certainly steer you in the correct direction for that. Functionality and features, I'm going to go over in more detail when I give you a brief demonstration of our software. The users of OptionsCity, and I want to kind of briefly talk about this. Sure, we're great in the pits, and our software is very good for the tablet market makers, such as in the VIX pit at the CBOE. Our software is very good from that, and it's also very good for the prop traders, but not just in the trading community. The hedge funds that Jay alluded to, larger banks, or just customers that are constantly wanting to, overlay their values of how they value the options versus the market, or just as a good indicator. So that's another good reason to use OptionsCity. Quick overview, if you're not familiar with our software. We were founded in 2006. We've had explosive growth in these 5 years. Basically, we provide a real-time multi-asset class electronic trading platform for professional options traders, such as traders that would trade the VIX. We're an end-to-end solution. Basically what that means is we can do everything from your modeling of your pricing, your market making. We do electronic eye to find your specifically what you would like to trade. We're very fast at execution, and we have very comprehensive risk management. We're a certified independent software vendor on all the major exchanges, and as I had previously talked about, we have great relationships with all these exchanges. Quickly going to our architecture, we are a server-based system. That means that our server is going to be co-located at the exchange. We're going to locate our server right next to the CBOE matching engine. It's going to minimize that latency. All of our calculations and execution is going to be done at the server level, so it's going to be right there, boom, boom. It's probably going to be quicker than before you'll even see it if you're wanting to do, it's going to be in milliseconds for people that are into that. From the server, we go to our City front, which is our user interface. The calculations are going to be done at the server level with the exchange, but our City front can be on a tablet in the pit, It can be upstairs. It can be at your house. And these are also can be communicating with each other. Because we're an open architecture, it's very scalable, so we can have multiple clients interacting with the multiple servers on multiple exchanges if the case need be, to do your spreading across the spectrum of exchanges, or if your guy in the pit is also, your guy upstairs is saying, hey, what are we doing? We can provide all that in real time, so you'll be able to keep up with your positions. The functionality, and this is what I'm going to get into in our demonstration, our modeling, we're very strong at providing the different, whatever model you're using, I'm going to show you how we can manipulate that to create your values. Click trading, I'm going to show you that we can click trade from just about any window within our architecture in our software. The electronic eye, I'm not going to get into a lot of detail today, but this is a really powerful feature that a lot of traders like. Basically what we can do is you can define what space specifically you want to look at, the range of strikes, the range of months, or strategies. You can tell your server to look specifically for these instances and show me where there's opportunity within these parameters that you set. We also allow auto execution of those strategies, and we can also auto hedge from those. Auto quoting, this is going to be more for your market makers. We have the ability to auto quote obviously from our software. You can lean, you can market join, you can again drill down for exactly what you want to auto quote. The volatility trading, that's basically again, we're setting our parameters, setting our prices. We're going to overlay that with the market price, and we're going to make trading decisions based on that. And our risk management is real-time comprehensive risk. It's not you're not having to go up and reset it every whatever parameter, 20 minutes, whatever, is constantly updated. So you can see in real time where exactly your risk lies throughout the term structure of your trading. I've gone over the users already, and basically what I want to do at this point, I want to go over a brief demonstration of our software. So if you can bear with me for 1 minute. And what I'm going to do here is I'm going to bring in, thank you, Jennifer. There's my health center, my city center. Okay. This is going to be basically when you open up our OptionsCity Metro. Up top, this is going to be where all of our icons are to bring up these windows. I've got most of them already open. What I've done here for City Market is I've brought up the term structure that we've been talking about of the VIX Futures. And for some reason, my September is on top of October. I don't know why it's done that. But since the September expired this morning, basically what I want to show you is we're bringing in the live data. Let's say, for instance, right here, November is 32.45 at 32.5. It's 16 by 25 right now. Obviously, we have the ability to quickly trade out of this. You can do that throughout your entire future structure. Just wanted to show you that. We are options software, so I would like to then go into our options pricing. Again, what we're going to do here is we're going to configure our prices. We're going to overlay it with market data, and basically that's going to present your trading opportunities, or it's going to show you where you need to adjust your different inputs. What I want to do first is let's create our values, our option values. So what we're doing here is we're using your basic theoretical pricing, which in this case is going to be the Whaley model for you options traders. But to further just do that, we've also got to create our skew. So I'm going to go into October, and you can see this is my term structure that I've created. I'm going to quickly bring in some live market data. And they're not a tremendous amount of data points here, so this looks kind of simplistic. But you can see that these red dots represent the live market offer, and the blue dots are the live market bid. The green line is where my pricing is. So you can see that we're pretty close on. The neat feature about our software is you have the ability to quickly change your structure. If you can see, I'm dragging this, and I'm changing my pricing throughout my options. in October, and it's quickly able to do this. You can also over here enter this by data point, and this is all easily importable, exportable to Excel, where you can manipulate it yourself. You can save it to go back and rehash it throughout the day. But basically, this is how we create our pricing through our modeling. I can show you our term structure throughout the products. Disregard this blue line. This is the one that expired this morning. But you can see October, then we have November, December. It's showing you basically how the different option pricings are structured throughout the term structure of the various months. So I created these prices. I publish it to my server. My server is then going to accept those prices, take it to our trade sheets. How do we use these prices that we've now used? What I've got here, and I'll show you how we can quickly configure these trade sheets. Again, this is all easily changed and manipulated. What I have here is I put our call price on the left, our put price on the right, and I brought in the live market data. If I want to change that and put something else in, if I want to bring the vol in, I can quickly drag it, drop it in here, and then that's what I put in. But I just want to show you that. So basically, let's go back to the at the money, which are shaded. The October 32 and all right, now we'll do the October 32.5, and this is a good point to make while we're here. This is your current data. Your October VIX is trading 33.45, so the nearest strike at the money is right in between. We're going to go with the 32.5. We've got it worth 33.92. The market's 390 at 410. It shows me I'm on the market. But let's say that I did want to trade something here. Okay, look, that was pretty close. It lit red. I want to sell that. I need to sell some vol here. Boom. I brought up the ticket, hit sell, easily to trade right out of this. We can also trade out of this. We can set spreads throughout our term structured month, set them up. You can quickly trade this, request a quote from this. Again, we're putting our values in. We're seeing the market stuff, the market values, and we're creating opportunities, whether or not we want to sell, whether or not we need to change our volatility. It's showing us what we need to do in the market. From here, I'd like to go to the what we call the city market. This is just another way to present our data. Here's our October again. We have our strike down the middle. We have our calls over here on our left, the puts on the right. Here's our theoretical pricing. Here's the market bid, the market offer. And the cool thing about this window that we didn't have in the last is we have what we call a heat meter. And what this is showing me is the relationship, the relativity of my prices versus the market. So when this is showing a huge bar, 93%, I know that something's off. I've got this option worth 80 cents. The market's pricing it at 90. So that's showing me that either A, it's a great opportunity, or B, since there are a lot of bars here showing me that we're off, maybe I'm a little bit off in my pricing these out of the money calls. Let's say that I trust my values over the market and I want to react to that and find a trading opportunity. I quickly click, it brings up a trading ticket again. Find opportunity, act on it very quickly, very efficiently. You can also on our mission that I talked about, you can find these opportunities, and you have the ability with our software to auto-execute your strategy within your parameters, and actually auto-hedge too. So you can go in, trade the options, and then go in and trade your VIX futures against that to keep your deltas flat. From here, I want to bring up our time and sales. This is showing us everything that's traded since we started this webinar within the VIX options. If I want to further quickly see just what I've done, here are my trades that I've put in. You can do it by trader, you can do it by group, you can do it by product, however you want to customize it. Again, in this, I'm showing you even within our trade sheets, we're having our heat meter showing relative to our values where things traded. Obviously, things have changed since I put this in, but it's showing me, hey, 100% opportunity. This traded at, let's find one here. It traded at 1270. I've got it worth 1213. There's a trading opportunity. Let's click on it, bring it up. Hey, let's sell that. See if anything's there. Click. If it was there, I got it. Again, overlaying our values versus the market to see if there's opportunity and ease of trading out of that. From here, I quickly want to show you our risk management. As I told you earlier, our risk management is done in real time. As soon as you put a trade in, it's reflected in your risk sheets and reflected throughout your Greeks. Basically what we have here, here's your at the money. Here's my day trading. I'm down a little bit of money. My deltas, I'm pretty flat. And then showing me my relative Greeks. This is showing me up. This showing me up 5 points. I think I have this in absolute terms. You can do this in percentages or in absolute terms. A $5 move, here's where my reflective Greeks and P&L are going to be. Down 5, down 10. You can further break it down by just the VIX options, and then within the options further by each month to see where your positions are, and then your future. Quickly, we can also do this in our position report. You can show all strikes, or you can just show yours. This quickly boxes off your entire position. You can see here that in October, it looks like I've got the 30-40 call spread on, and then I've got something else here. I'm long 34 of the VIX futures against it. So it quickly boxes off your entire position to kind of see where your risk is. And then we can also see our edge. So I can show relative to my theoretical pricing within each strike where my edge is on or off. Risk report, again, easily configurable. You know, here I want to see my deltas, my P&L. Let's say I want to bring in something else. Jay had talked about rho before we got here, which is interest rate. Okay, now rho is my most important thing ever. I want to put it in here. Done. It's now reflected in my sheets. Let me refresh this quickly. One other thing I want to show you in the risk report. We're going to set an offset. This is to kind of set your what-if situations. If you want to do your days, a couple days forward, hey, let's take out that weekend. I want to see what I'm going to look like coming up, you know, over a long weekend. Let's use the offset. It's going to push everything forward 2 days, reflecting on all of your Greeks and your P&L. What it's also doing is visually showing me, hey, this is highlighted in yellow, Jim. So this quickly shows you this is not your real-time risk. This is your offset. Okay, dummy, don't do it. Now you've taken your offset. Now it's back to real time. It's in real colors. Again, visually showing you things, trying to make it as easy as possible for you to concentrate on what you want to trade, what's most important to you, whether your biggest thing is volatility trading, whether you're a spreader, whatever it is, you can configure our software to show you what you want and to quickly act on it. This is a very, very brief primer on what our software can do. I know a lot of people that are listening use our software. For those of you that don't, we would love to show you a lot of the other features that are very, very powerful that basically put you in the game to have the ability to trade things such as the VIX. I don't want to get, I would be remiss if we ended this without talking about this one more time. This VIX product has really taken off as far as a trading entity instead of just an indicator. People are actually using this to trade now, whether it be hedging or whether it be just looking for opportunities as a prop shop, market maker, or just an active investor. The VIX can, as you can see, the VIX futures can be volatile in themselves, but the options on the VIX future can be quite volatile and very quickly changing and very confusing. So you really need a tool that can help monitor that risk and, more importantly, help manage your risk in these changing conditions, especially when your volatility has gone crazy in the front versus your term structure in the back. And how do you keep up with that? I think our software is the most powerful tool that you can have to kind of integrate this all together. That's basically our software in a nutshell. I'd like, from the OptionCity's point, like to thank Jennifer and Jay for coming here today and giving everyone a great overview of this VIX future, the history, the structure between the index and the future, and the options on that. we're constantly trying to find ways to show our customers new products and different things to trade, and most importantly, opportunities in the trading world to make you money, which is why we're trading in the first place. For more information, please visit our website. This is going to be on the web. Jay, Jennifer, do y'all have anything to add here before we wrap this up?
I would say that people in the audience, years ago there used to be conferences just devoted and dedicated to is volatility an asset class. I think most would agree that it certainly has reached that point nowadays. Volatility is certainly more mainstream. It's in the vernacular. I think my mother even knows what VIX is nowadays. So Jim's absolutely right. It's an important product to consider when you're looking to mitigate risk or make use of opportunity in the marketplace. And as you've seen from the demo here, OptionsCity allows you to not only gather all the necessary information, but hopefully help you capture some edge. I would only add that I don't know that Jennifer and I had a contact information page with our email addresses on there.
We didn't, but we have our website page, and you and I are both on the CFE front page website. So you can get a hold of us that way.
Or ping Jim or Steve listed here, and they'll be happy to forward your contact information or questions to us too.
Exactly. Thank you.
Thanks, everybody, for coming in today and listening to this. We hope to be able to help you in the future, and good luck trading the rest of the day. Thanks for coming.
Thanks. Bye-bye.
Bye.